Step into the super crowd, where dreams take flight. Learn to invest like a pro, make your future bright. Impact investing, changing the game. Crowdfund the world, it'll never be the same. Super Crowd Hour, come join the ride. Change the world with us, we're on your side.
Hello, everyone, and welcome to the Super Crowd Hour from the Super Crowd. I'm really excited to host you today. Today, I'll be sharing some information about how you can achieve a high-yield portfolio of crowdfund investments, impact crowdfunding investments that will match or perhaps even beat the return of the stock market. Now, I think this is important for you. I think most of us, either directly or indirectly through 401ks and whatnot, have investments in the stock market. And if we begin to believe quite genuinely and truly that we can match the returns we get there with impact in the crowdfunding marketplace, we can begin to move some of our assets deliberately, slowly, carefully, over time, into higher impact, make a difference in the world, make more money for us investments in the crowdfunding space. I think this is exciting and important. So let me get started. I want to thank our producer, Chandan Saha. He does a tremendous job for us. I couldn't do this work without him. I'm extremely grateful for him. I need to note that I am not a financial advisor. I'm certainly not your financial advisor. So as we talk about this stuff today, I want you to put this into context as educational information. I encourage you to consider it. When you're ready to make investments, I encourage you to seek the professional help you need based on your circumstances. We are at the Super Crowd hosting a monthly meeting of our Impact Cherub Club, and you're invited to join us. We have a lot of fun. We're building a movement, right, of people who are making impact investments in small dollar amounts. All of our members are participating actively and investing in the marketplace in small amounts, and I encourage you to join us and participate in that effort. So think of us as small angel investors. We're focused on impact. We think of ourselves as impact first investors, but we scrutinize every deal to look for the financial situation, the financial returns as well. We meet monthly on the third Tuesday of each month at 1 p.m. Eastern. To learn more about joining the club, visit impactcherub.com. It's easy. We would love to have you participate. I also want to encourage you to subscribe to our newsletter, to join the Super Crowd. Be a part of our community broadly. Even if you're not ready to join the Impact Cherub Club and be all in, test the waters with us by just subscribing to the newsletter, by joining the Super Crowd. We would love to have you. I encourage you to check it out. This is an easy way to begin learning not only about how to invest for impact, but also how to raise capital from the crowd. We cover both sides of that coin off and on. This month, we're focused on the investor side. Next month, we'll be talking about how to raise capital. So please join us. Visit superpowersforgood.com or scan this QR code to sign up today. I want to tell you how you can get my book, How to Make Money with Impact Crowdfunding, absolutely for free. You can get an ebook copy absolutely for free just by visiting www.4sc.fund/ebook free. And you can get a copy of this book that's a really fresh book. We just published this book 9 months ago. So this is still very fresh. Their hard copies are available on Amazon and elsewhere, but check it out. This is a great tool for learning how you can invest like a pro. I also just wrote a new book. This is about raising capital from the crowd. Crowdfunding Made Simple, a step-by-step guide to raising capital using AI tools. That's so important. Crowdfunding is a lot of work, but when you use AI wisely, it accelerates the process tremendously. And so we walk you through step by step all the things you need to do and how you can use AI to accelerate that process. Check it out at 4sc.fund/CMS free. Again, free ebook copy. Paper copies are also available from Amazon. I want to just, let's see. I've got to roll a little clip here before we get started. Forgive me. We need to acknowledge our tremendous supporters and sponsors. So check this out.
Digital Niche Agency is the top investor acquisition agency. DNA has helped founders raise over 9 figures via regulated investment crowdfunding with a 3-pronged strategy using digital advertising, content marketing, and strategic outreach. You can't argue with success, but you can learn from it. Put the best to work for you. Book a call today.
Proactive Impact Fund creates social impact through real estate, and you can invest. Learn more at proactiveimpactfund.com. Start today. Brian Christie and his team bring strategic innovation to crowdfunding. Scan the QR code to learn more about Crowdfund Holdings innovators now.
We are grateful for meaningful support from the American Independent Business Alliance, Ridgecrest Herbals, Move the Needle with Rob Kaplan, and Rotary International.
We appreciate our co-hosts.
Prepare to be inspired by Devin Thorpe, a powerhouse in impact journalism and social good advocacy. This best-selling author hosts the acclaimed Superpowers for Good TV show featuring global changemakers like Bill Gates. With a readership of over 2 million, his 500-plus Forbes articles have shaped the dialogue on purpose-driven leadership and crowdfunding innovation. A sought-after speaker from the United Nations to Johnson & Johnson, Devin's unique blend of expertise as a former CFO and investment banker fuels his captivating presentations. Please welcome the dynamic and visionary Devin Thorpe, here to empower us all to harness our superpowers for good.
Well, I'm excited to tell you about Karina here. Karina is a baker, and I invested in her business about 6 months ago. I made a little investment in her business, and this investment is kind of it epitomizes what we're talking about today. And so I want you to just get a sense of the flavor. You say, well, what's so special about Karina's bakery? There is a lot. There is a lot that is special about Karina's bakery. Karina is legally blind and really struggles to see at all. And so she is a remarkable human being. This photo of her was taken at the 6th anniversary of her bakery. Imagine running a bakery successfully for 6 years when you're legally blind. I think that's really an accomplishment. But it doesn't stop there, right? virtually all of her employees are also disabled in one way or another. And so she has become an employer of disabled people. And you say, well, that's nice. Keep in mind that 70% or more of people who have a disability are not employed. And most would like to be in one way or another. And so she has developed and really is quite sophisticated about the accommodations she makes. She's got one baker on her team who is completely blind and functions very well on her team. And so she's made some accommodations to make that work. On top of that, they're not just making delicious baked goods. And keep in mind, you have to make delicious baked goods to stay in business as a baker. Let's not kid ourselves, right? You can't deliver yuck and stay in business. It's delicious. It's also vegan, right? So all plant-based, 100%. So that means that there is less harm to the planet, less harm to animals. And I won't make a strong argument that it's healthier. After all, we're talking about sweet treats, but maybe a little bit healthier than eating, animal-based sweet treats. So anyway, it's an amazing, amazing operation. I'm proud to have invested. That's the kind of impact you can have. And Karina is paying me back, right? I invested in a loan to her at a nice interest rate, and it's a win-win. She's got a lower interest rate than she'd pay on a credit card or other funding source that's high cost. I'm getting a much better return than I can get from the stock market. Win-win. I love this. This is kind of a prototype of what we're talking about today. So let me get into this. We're going to talk today about how you can build a high yield portfolio that cash flows and meets or beats stock market returns. As you begin to do that, you'll begin to appreciate that you can move some of those assets from your IRA or 401k or your other stock markets brokerage account into crowdfunding because it'll achieve the same financial objectives. Okay, let's talk a little bit. This is review. If you followed me, you've heard me talk about this a little bit before, but I recognize that there's some folks who are tuned in today for the first time. And I want to make sure that we put this context out there clearly for you, right? Over the long haul, stock market returns average about 10%, and that is a good return. If you can get it, that is great. But it also varies widely, right? The last 2 years was closer to 24% up. We've had a phenomenal couple of years in the stock market. That's interesting that it's been so incredibly strong. And so I encourage you to let's be a little bit cautious. Over the long haul, stock market returns always sort of drive back to 10%. So what that means is sometimes the stock market goes down. Sometimes the stock market goes down a lot. So from October 9th of 2007, and those of you who've had at least 30 birthdays can probably remember this, from October 9th, 2007 to March 9th, 2009, 17 months, the stock market dropped 56.8%. Can you even imagine? That's like 30% back-to-back years. That's just huge drops. So that is not an outrageous experience. A decade earlier, that dot-com bubble burst and NASDAQ dropped 80% in about a year. And it took 15 years for NASDAQ to get back to where it had been. It is a really volatile marketplace, investing in the stock market. It is not a consistent 10% every year. It's pretty reliable if you are investing over your lifetime, right? That's why people talk about investing in the stock market, and so much capital is invested there. There are some things to consider here, and I want to make sure that we are kind of thinking through these issues. Getting market returns is virtually impossible. So even though the market delivers 10%, investors rarely get that much. Now, some get very close, right? The people who get the closest are the people who consistently, persistently put their money to work in mutual funds or ETFs with low fees that are called index funds. These funds track the market, and so they just go up and down with the market. And so if the market has a bad year, your fund has a bad year, your account has a bad year. But over the long haul, you track the market pretty closely. The only difference is the fees. But most of us, even if we invest in ETFs, mess up at times. Sometimes we think, I know better than the market. It's not going to go up anymore. And we pull our money out and then it goes up and we miss that. Or it goes down and we panic and we take our money out of the ETF just before it turns around and starts going up again. So we make emotional decisions. We make mistakes. So it's very, very difficult. And if you're trying to manage your own money more actively, like I do, it's even harder to match market returns because we make mistakes. And as individuals, we have to remember the information available to us is inferior to the information available to the savviest large investors. We're disadvantaged. That shows up in our yields. So we cannot, as individuals, expect to beat the market in the long haul. We can beat it for a year. I've done it. We've all probably had that year, right? You cannot do it over the long haul. It's virtually impossible. So the reality is, on average, individual investors probably earn about 30% less than the stock market. So that 10% benchmark is ethereal. It is aspirational. It is not really reality. We can't really earn a 10% return. A reasonable expectation is closer to 7%. Now, I will often talk about trying to match that 10% rate. I think it's a good target to have in mind. I like that. But the reality is, you're not going to get that in the stock market. Keep that in mind. Okay. When I talk about impact crowdfunding, what I'm talking about is the intersection of investment crowdfunding, which is not, let me be very clear, not Kickstarter and Indiegogo, certainly not GoFundMe, where you're giving money away. We're talking about investments. If you're not familiar with this, you may not recognize names like WeFunder, Start Engine, Honeycomb Credit, Republic, but there are lots of intermediaries called portals that offer securities, real investments like you make in the stock market from small companies, some startups, some small businesses that have an operating history, like Karina's Bakery, small business with an operating history, right? All kinds of different things available in the investment crowdfunding market. And then there is this long tradition that, I say long, it's really began in earnest about the beginning of this century, in about the year 2000. People began talking about this idea of impact investing, that we could use our money to invest with an impact. And there are some really easy ways to recognize what that is. Like, big money investors recognize that if they invest in a municipal bond that funds a mass transit system, it moves people from their cars into transit. it saves the planet, and that municipality guarantees the debt. The riders essentially pay for the debt, and what you get is a great low risk return that is saving the planet. There are all kinds of these things, but the practice of impact investing has really been the domain of institutions, a little bit of foundation money, not as much as should be invested from foundations, and wealthy individuals, really high net worth people. I'm not talking about the doctors and lawyers in the world. It's really the people who have net worth of 25 million and more. They're really truly high net worth individuals, including, of course, billionaires that have been playing in this marketplace. But now impact crowdfunding allows ordinary folks like you and me to invest for impact. This is exciting. So in the crowdfunding world, in really basic terms, there are two kinds of investments. Basic, I'm really simplifying, but there are debt and equity. And there are, in the equity world, sometimes we will see convertible notes, but those convert into equity. So those are really intended to be, and they are priced based on their equity return potential, even though there's a debt structure there. When I talk about debt, I'm talking about loans that remain structured as debt throughout their whole lives. So let's talk a little bit about how to build a high yield portfolio focused on term loans. That's a subset of the debt instruments out there. I wouldn't include in this strategy people who are investing in revenue-based financing. We'll talk about that another time, maybe in 2 months, or maybe in March. We'll come back and talk about revenue-based financing. I think that'll be a fun topic. In any case, we'll do this now. We're going to talk about today term loans. And term loans, just so we're clear, it's the same kind of thing. Most of these term loans are structured in really exactly the same way, or very similar to the way a car loan works, right? So if you buy a $50,000 car, you're going to make payments probably for about 5 years. If you can afford it, maybe you'll cut that term down to 3 or 4, but you're going to make payments for a fixed number of years, and every payment includes a portion of principal and a portion of interest on that loan. And after you've made all the payments for 4 or 5 years, you own the car free and clear, and you have a clear title to that car. Okay, it works the same really as your mortgage, right, on your house. Many of you are familiar with your mortgage. You have a mortgage, and so that is also a term loan. It's a very long-term term loan, and that's rare in the impact crowdfunding space to see a 30-year loan that you can invest in. It could happen. I haven't seen one yet, but it's the same kind of thing. I want you to recognize that when we talk about term loan investing, it's the opposite of borrowing, but it's the same familiar instruments, right? This isn't an exotic, scary place to invest. This is really straightforward, right in familiar territory for us. So the term loans that we see most often, not exclusively, not everything fits into this paradigm, right, or this framework, but most in the impact crowdfunding space looks like this: 24 to 60 months, so 2 to 5 years, interest rates of 10 to 16%. Again, it varies. It's not always in this parameters, but these are the typical terms that we're seeing. Remember the stock market, 10% return over the long haul, very volatile. Here we see 10 to 16% loans are common. And so you can build a portfolio of these loans that would beat the stock market if everybody pays you back. And these loans are typically, not always, but typically fully amortizing. And what does that word mean? That means it works like your car loan. Every payment includes some principal and some interest. So the cash starts coming back to you very quickly, usually within 60 to 90 days, the cash is coming back. You're getting those first loan payments, and you're seeing that this is working very quickly. Very nice. Okay, so what are some of the variations? There are all kinds of variations, and I've invested in a whole variety of these different variations. And one of the scariest, but I've done it, is a loan that doesn't pay anything until the very end. And all the interest was due in one lump sum. It's less scary if that term is 1 or 2 years. It's scarier if it's 7 years, right? A lot scarier if the interest just accrues. But that will sometimes happen. You got to ponder whether you're willing to accept that risk. You don't have to do it. No one has to do it. Ponder it. Is the impact something you support? Is the borrower credible? Is there a reason why they're going to pay it all back at the end? For instance, when they sell the project or something. So there may be a very good reason for that model, but you don't have to do it. That doesn't appeal to you. We also see lower interest rates occasionally. And sometimes those low interest rates are correlated closely with very low risk deals, right? So I've invested in a green bank that has very low interest rates on its debt. So I'm not getting a very good return. It's very low risk. This is a bank. It's not an FDIC insured deposit, but it's a very low risk loan for me. And so I'm okay that it's a lower interest rate. Sometimes businesses with very high impact will pitch to their communities a low interest rate. And what they're essentially asking you to do is to sacrifice a portion of your return, like making a donation by supporting them with a low interest rate. You can choose to do that. I encourage you to consider that in the same way you would consider donating to that organization. If they are pursuing something that resonates with you, that is truly tugging at your heartstrings and you want to support them, this is a great way to do it, because not only are they giving you your money back, but a little bit of return on your money, so you can recycle that money and have more impact. So it really is a win-win. Be aware that not all of the low interest rate loans, though, are correlated with low risk. In the conventional market, there is in the stock market, there tends to be a clearer equilibrium of risk and reward. In crowdfunding, you've got to do your due diligence. And we'll talk more about that again, to make sure that the risk and reward and the impact all come together in a way that makes sense to you, right? Sometimes a loan will just pay interest until the end of the loan. So you might get quarterly, semi-annual, or annual interest payments until the loan matures, and then there will be a final interest payment and all of the principal at the end. That's another way. And we also see loans that are sometimes shorter than 2 years, 12 months, 18 months. It's not very common, but we see those. I've invested in some. We also see some that go beyond 60 months. So I've made some investments that go out 7, 8, and 10 years. So there are a whole variety of things. This is a little bit less common, right? These are the variations that fall outside the norm. We talked about the norm, but so that, the norm, 24 to 60 months, 10 to 16% interest, fully amortizing. That's the norm, but the variations, we see those. I want you to feel comfortable that it's okay for those things to be different. Just evaluate them carefully before you invest. So let's talk about building the portfolio. And it's really important that you think about this from a portfolio standpoint and not from an individual loan standpoint. it is impossible to know with certainty which loans will fail, but we know some will. And in a recession, more will. One or two loans that go bad. But we'll talk about this. We're going to talk about two different approaches for impact investing in loans. And you can use either one. You can start with the hobby approach and then shift into Maven mode later on after you build your confidence. That's a perfectly reasonable approach. What we're talking about here, I had a little internet glitch there. I apologize. I think we're back. But what we're talking about here with the hobby approach is to invest a small, consistent amount each month. Let's say $100. You could even choose a number lower than that if you want. It's possible, and I'll tell you, you can do that. But it is clearly possible to do that, and you just invest in short-term notes in a consistent amount each month. What will happen is that in 60 days you start getting payments back, right? So in January you make an investment, in March you get your first payment back, right? So if you just make up the difference starting in March, so in February and January and February, put in, say, $100. Then in March, you get a few dollars back from your first investment, right? So now you only have to invest 90-something dollars, right? And then the next month, you'll get two payments back. It'll be a little bit more money. And so you'll invest a little bit less to make up the $100. And so after 3 months, your payment, your investment keeps going down. If you keep reinvesting all the payments you get back, the money that you're taking out of your cash flow goes down and down and down and down. And so that you can build this portfolio of watching your reinvestment portion grow each month. And over time, it will overwhelm the cash you need to put in. And before long, it'll take 2 to 3 years if you keep make all of your investments in 2 and 3 year notes, and they're available. You can do this. If you make all of your investments in 2 and 3 year notes, by the end of 3 years, you can reasonably expect that the payments you are receiving will be equal to or greater than $100 a month, or whatever your monthly amount is. It might be 200, it might be 50, whatever it is. You should be getting more back each month than you were putting in to start. So if you keep reinvesting all of that, in the good times, your portfolio will grow a little bit. When things are hard, in a hard economy, one of your loans fails, 2 loans fail, those will stop paying. That'll hurt your cash flow, and you might have to go back to putting a little bit in to support your hobby. But the reality is, I would expect that in the good times, your portfolio will grow, and you may never, ever have to put money in after you reach the point where your reinvestment, the money coming back, exceeds your monthly amount, say $100. So this is just a fun way to do it. It's a fun way to build confidence. It's a fun way to learn the market. Yes, it takes time, but it's not overwhelming and it's not a lot of risk. Realistically, if you were doing $100 a month, you would put about $2,000 of money into this investment pool portfolio. And eventually you would end up with a portfolio that is a revolving portfolio that's worth a little bit more than $2,000. And again, in good times, it'll creep up. In bad economies, it'll it'll slide down a little bit, but it'll be a great hobby that's free and very impactful. You are genuinely helping people when you are investing in their deals. So this is a fun, high impact hobby. Now, I like to call the alternative mode the Maven mode. And a Maven is an expert, right? So I want you to think of yourself as an expert investor. And so you may start with this approach in mind. You may choose to shift to this after you have mastered the art using the hobby approach for a few years. So let's talk about what is the Maven mode. So here you're going to be a little more flexible on the kinds of loans you consider, not just the 2 and 3 year fully amortizing loans. If you're a Maven and you're taking the long view, which is the key difference, right? Taking a long view, and you're going to keep investing. So what happens is you can invest in a 7-year loan that pays everything at the end. I'm not saying you should do the due diligence. You consider it, but you could invest in all kinds of different loans. So you get to choose, but I would still stay focused on investing in loans with higher yields, 10% and above. Now, occasionally you'll choose to make something that is so impactful that you'll choose to invest at a lower interest rate, whether that's 8%, 6%, 3%. You choose, you do you. But I also want you to recognize that a portion of your investment in some ways is a bit of philanthropy. You are making a philanthropic contribution of the difference between the amount of money you might have earned on your money and the amount you're going to earn from that investment. And, I think most people, especially those who want to see good done in the world, are making philanthropic donations, large and small, every year. And so it's perfectly consistent to incorporate a little bit of philanthropic capital into your portfolio this way. But I would target finding those opportunities for impact that also have the higher yield. Okay, so here's some key things. Try to build that portfolio with at least a 10% average yield. And to get that, you've got to remember that sometimes people won't pay you back. So you've got to have some 12%, 14%, occasionally maybe a 16% loan in there. Again, those higher interest rate loans tend to be riskier. It's not perfectly correlated in the crowdfunding market yet. Do your due diligence. But if you see a risky loan but high impact, you may want to do it. So you decide, but build that portfolio. Recognize that occasionally people won't pay you back, and so you've got to you can still average 10% when sometimes they fail to pay. We'll talk about that. But I encourage you to keep reinvesting. All that cash that starts coming back, reinvest it. This is Maven mode. You're going to reinvest that, and you're going to put in a fresh amount every month. So I would put in $100. You could do $200. Maybe you're just doing $50 or even $20 a month in Maven mode, and you're still going to get proportionally the same kind of activity. But if you put in $100 a month and you are successful at averaging 10% over the long haul, which would likely beat what you could actually do with the stock market, you would have $2,600 in 2 years. You'd only have put in $2,400. So you'd made a profit of $244 in 2 years. In 10 years, you'd have put in $12,000, but you should have a portfolio over $20,000, $8,000 profit, really starting to mount. In 30 years, and most of us are going to be alive in 30 years. Even people with gray hair are going to be alive in 30 years, most of us. And so what does that mean? It means that if you invest like this for 30 years, you'll put in $36,000 of your own hard-earned money, but you'll have a portfolio worth $226,000. So you'll have made $190,000 of interest over those years. You really can accumulate some real value using this simple strategy. But this is different than the hobby mode. We're not just reinvesting our money, we're continuing to add our own hard-earned money in a consistent amount every month. In this example, $100. Okay. I have mentioned it already, and I just need to reiterate this so that we're absolutely clear. To get your 10% return, you're going to have to invest in loans that have an average yield above 10% because some will pay slow. Generally, when they pay slow, the interest will continue to accrue and they will have to make it up somehow, some way. So that usually won't hurt your long-term returns, but then there will be some who fail to complete all the payments. And your recourse as a small investor will be limited. They'll put together a committee. You're not likely to have a voice on that committee unless you're one of the larger investors. And some, it's possible that for a variety of circumstances, you will put money into a deal and they never make a payment. That's going to be very rare. But if you're talking about a 30-year investment horizon, I promise you will see one of those. That's why it's important to diversify. Make sure you're putting your money in a variety of different loans and not concentrating all of your money in a single. Don't get excited about Karina's bakery and put all of your money in her bakery as an example, right? She's doing amazing things, so impactful. I'm so proud of Karina. Love what she's doing. I'm grateful to have had the opportunity to invest in her business. But you can never guarantee that someone's going to be able to pay you back. So don't concentrate investments, diversify, put them in lots of different places. So let's talk a little bit about diversification. This is important whether you're doing hobby mode or Maven mode, but especially in Maven mode because you're talking about real money, a big part of your retirement potentially. This could be 10% of your retirement if you are serious about this. So what are we talking about for diversification? You want to look for different maturities. Part of that is to hedge on interest rates. Interest rates do go up and down, and in a recession, interest rates will drop. So it will feel painful that just at the time when some of your loans are not paying you back, your new investment opportunities will be at lower interest rates. Yikes. It's a double whammy, but that's what happens in a recession. Interest rates drop because there's less demand for money from eligible qualified buyers, borrowers. So interest rates will drop. You can expect that. That'll hurt those windows of time. Remember the long haul. So you want different maturities. You want to invest across portals. There is a little bit of risk in keeping all of your money invested in a single portal. It's tempting. There's some great portals that I just love for this kind of investing, but I want you to be aware there is a little bit of risk that there could be a pattern, an error in their underwriting process, their screening process that is systematically exposing you to a risk that could cascade on you all at once. So you want to invest across portals. You want to certainly invest across industries. And that may not sound important when you're investing in small businesses, but I would strongly encourage you. I've invested in such an odd, eclectic portfolio of things that, recently invested in a little shoe manufacturer on a deal like this. I've invested in restaurants and bakeries and, look for opportunities to diversify your portfolio strategically, and recognize if you have a pattern of concentration that represents a special risk you need to monitor. And then also manage your money across communities. It's very tempting, and I love the philosophy behind investing more of your money in your local community. If you choose to invest a lot of your money or all of your money in your local community, I implore you to get professional advice. That is risky, to put all of your money in one community. Imagine something happens, like a major natural disaster. I think of our friends in Asheville, North Carolina. I think of our friends in Los Angeles this week. In Pacific Palisades, have just been devastated. Imagine that all of your investments were in Pacific Palisades and they were all burned up. The risk to your portfolio would be huge. So I want you to get professional advice if you decide to put a lot of your money or all of your money in your own community. It's extra risky. Yield. There are two primary websites where these typical term-based loans show up: honeycombcredit.com and thesmbx.com. Some of the things I love about Honeycomb Credit, they're going to label opportunities for impact, right? If there's a social impact, they're going to highlight that. If there's a minority founder, they're going to highlight that. If there's a veteran founder, they're going to highlight that. A woman founder, they're going to highlight that. An LGBTQ founder, they're going to highlight that. So you have an opportunity to align your investments with your values more easily. Now, on the SMBX, what I love about the SMBX is they do a tighter job of underwriting. So you'll see a narrower range of interest rates offered on the SMBX. And the reason that is the case is that they are underwriting. And so some of the loans that might appear on Honeycomb Credit wouldn't qualify to be on SMBX. But on SMBX, it's a little blander storytelling, right? You're going to get just the facts, ma'am. That's what you're going to get. And so I miss some of the qualitative, impact-focused narrative. You've got to seek out the story. You've got to do a little more due diligence to understand the impact side of your investments on the SMBX. But those are the two great websites for investing in these kinds of classic term loans. Now, let's talk a little bit about due diligence. And we will have a future session devoted entirely to due diligence. But let me just highlight a couple of things. Before you make an investment, you need to do research. And we call that research that you do before investing due diligence. And I've built a tool to help you with due diligence using ChatGPT. And I do think ChatGPT is the best tool for this, at least right now. That could change. I've tested Gemini a few times. It doesn't keep up with ChatGPT in terms of delivering the facts and the analysis as well as ChatGPT does. But visit 4sc.fund/AIDD. That is AI, due diligence, right? 4sc.fund/AIDD. That will help you if you follow the instructions. It doesn't make due diligence instant. In an hour, you can do a thorough job of understanding and offering so much better than you could just by trying to browse the offering page. So I invite you to check that out. Let me tell you how you can start your investment journey with as little as $10. And I think this is an important principle, because before any of us put money to work in this marketplace that would really potentially hurt us, we've got to learn to sort of take a crawl, walk, run approach to this. You've got to feel confident before you put $10,000 to work in this, before you've accumulated a portfolio of that size. So you can start with $10 at SMBX. We talked about SMBX just a minute ago. The website is thesmbx.com. Climatize is climatize.earth. Most of their deals are non-traditional debt deals. Occasionally they're equity, but most of them are what I would describe as non-traditional. They're not the fully amortizing 2 to 5 year loans. They're different than that. But they do take investments as small as $10. So these are two places where you can get started with debt deals, pay interest, and start with $10. So I encourage you to check that out and get started there. I want to highlight one of the other investments that I've made because I want you to have a sense of the dynamic, the opportunities for you and the diversity of those. So this is a woman, Nikia, that runs Abodo bookstore. It's an independent bookstore in Stratford, Connecticut. So it's on the other side of the country from me. But I love the fact that she is a solopreneur, that she is doing something that is very community oriented. She's got all kinds of things going on in her new bookstore, community events. Of course, she's selling books, but that's just the beginning. She's also doing a variety of other things, yoga class, all kinds of stuff in her space. Of course, she has authors coming in to speak and do readings. She's phenomenal. She's great. I encourage you to look for opportunities to back entrepreneurs who align with your values and support them. This is a tremendous way for you to have impact on the lives of individuals and communities. So go for it. Go for it. Now, again, I mentioned this at the top. I want to come back to this. You can get the information I'm talking about is all in my book, How to Make Money with Impact Crowdfunding. Visit 4sc.fund/ebook free to get your copy free. It's an ebook copy you can get free. It's also available on Amazon if you want to check it out there. You can get it in either for your Kindle, or you can buy it in paperback form there. But check it out. Now I've got some time. We've got I think we have just about 5 minutes for some questions. So we don't have a lot of time, but I'm happy to take some questions if anyone has it. So we got a question from Jason Castillo. Why is it so difficult for individual investors to consistently match or beat stock market returns? Great question, Jason. Let me tell you, the reality with that is that we're humans. We're human beings. And, there's been some great analysis done, right? There are fund managers who appear to consistently beat the stock market. One of the most notorious stock market beaters was Bernie Madoff, right? And what did we learn? He didn't beat the stock market. He lied. There are a few that consistently do, but there are thousands upon thousands of money managers, and a tiny fraction do that. The tiny fraction that beat the stock market consistently aligns with the tiny fraction you would expect if you randomly distributed results, right? In other words, there is no evidence that fund managers can consistently beat the stock market. And those are the smartest people in the marketplace. Many active fund managers trail the market. And of course, by definition, an ETF or a mutual fund that is an index fund that tracks a market index will trail that market by at least the fees that the index fund charges. Now, typically an index fund, because a lot of that is all automated, those fees tend to be very modest because, again, there aren't a lot of people spending a lot of time managing that money. It's all automated, and so the fees are low. But there are fees, and that means you will trail the market. And so instead of getting 10%, you get 9.8%. And that's the best you can do. And that presumes you never take any money out. You never invested at the wrong time, all kinds of little assumptions to meet or beat the market. And of course, if you're a human being and you panic when the stock market goes down and you pull your money out, you may watch it rise for years before you feel like you're ready to go back in. It can be devastating to your portfolio. I like to think of myself as a savvy investor, and I can remember the time when I sold Zions Bank at the bottom of the market and then watched it go up, 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 up. And, within about a year from when I sold, it was at about 8 times what I sold it for. So all of us are humans. It's easy to make that mistake. That's the reason, Jason, that we see that we can't. John Mason, what factors should I consider when evaluating the terms of a loan? Great question, John. I appreciate you submitting that question. The reality is, the interest rate is a key term. That's really, in my mind, the most important. The second most important term would be the length of the loan. And especially in Maven mode, you want to look for longer term loans that'll lock in higher interest rates for a longer time period. That's really strategic. On the other hand, in hobby mode, you want to stick with the shorter term loans. They will tend to have slightly lower interest rates, but there's a lot less risk in those too. A lot less can happen in 24 months or 36 months than in 4 or 5 or more years. So those are the two basic things to be looking at. And I want you to be thoughtful and strategic about those. But there are other things to consider as well. Is there a personal guarantee? And is there some sort of collateral supporting the debt obligation? And typically on Honeycomb Credit, there is a personal guarantee. That is their standard. I don't know if they ever veer from that. On SMBX, there is no personal guarantee. And I would note that it is a much more founder-friendly approach to invest in loans that aren't personally guaranteed. So there's a trade-off. You need to recognize when there's no personal guarantee, you're doing essentially a favor for the founder. And if the founder is someone that you really genuinely want to support, and you are more affluent than the founder, you should feel good about that. On the other hand, if the founder is someone who's more affluent than you are, you may want that founder to be personally guaranteeing the loan. And there are clues, right? So you can check that out, but be thoughtful about those terms. Great question. I really appreciate that question, John. Shannon, any more questions? Okay, we've got to wrap up here. We've got just a minute. Let me just thank you all for taking the time to participate with us. I'm thrilled to have had the opportunity to walk you through these principles today. It is exciting, I think. I hope you share my enthusiasm to recognize that we can match the returns we're getting in the stock market, maybe beat them, with crowdfunding investments that have real impact on real human beings. That, to me, is exciting. Wow. We can make a difference in the world. That's just great. So thank you all for being here today. We want to see you here next month. We're always here on the third Wednesday of each month, beginning at 1 Eastern. We'll look for you next month, and we'll see you soon.